We're excited to be here. It's after seeing all of the high quality content that's been put on by the last couple of days, all of the inspiring speakers, all of the leaders that really showed up to spend their time and share it with everyone. It's been phenomenal, and I'm really happy and proud that we can take some time at the end of this to share some of our learnings that we've had at Viewpoint, where we're a quantitative investment management company, so applying data science and data science techniques to the global financial markets. And so with that, I'll kind of get us started here. So yeah, we're going to be talking about supercharging investment research with data science. We've got myself and Amin together. We lead the R&D division for Viewpoint Investment Partners, where, as I mentioned, we're taking kind of at the intersection of data science and finance, trying to apply some of these learnings, to really deliver the best financial outcomes for our clients and do everyone's dream, which is use quantitative technique to try and beat the stock market. So before we get into that, though, before we get into the nitty-gritty of the financial world, I want to ask everyone, spend some time thinking, do you have a wicked problem? Now, what do I mean by a wicked problem? Well, the concept of wicked problems comes from design thinking in kind of the 80s and 90s. And wicked problems are especially difficult to solve because of their complex and interconnected nature. The idea originated in order to describe the complexities associated with, social and policy problems, such as, dealing with health and educational reform. But the idea of wicked problems extends beyond the social sciences into any domain where you've got interconnected self-referential aspects in the problem, and there are real-world constraints which prevent or stop risk-free decision-making or risk-free problem solving and constrain your options. All of these are aspects of wicked problems. So I think it's easiest to kind of talk through some of the characteristics of wicked problems, because this is going to be important as we go forward to understand what it means to do data science in the context of a wicked problem space. So first off, wicked problems are typically, you've got one shot to get it right, and each problem is typically unique, right? There's no opportunity to learn by trial and error. Let's talk through an example of that, right? Think about a gymnast who's learning a new trick. She's able to practice on the trampoline repeatedly in a risk-free environment. Now think of the Federal Reserve trying to figure out how they should use monetary policy in order to ease the impact of COVID, right? You've only got one chance to get it right, and it's a brand new problem that's never been seen before. There's also no single binary right or wrong answer when you're dealing with a wicked problem. There's several degrees of freedom. There's only good or bad, better and worse. Think about designing a public health insurance policy. There's, no matter how much you do, there are always going to be people who are left behind, and it'll always feel as if there's more that you could do. In wicked problems, there's also no immediate test of a solution, right? So, and this is actually one of the most brutal aspects of wicked problems. And so humans typically learn from feedback loops. When we take an action and good things happen, then we understand that we should take that action again, right? It's a feedback loop. It's a feedback system. Wicked problems often have delayed and even decoupled feedback mechanisms. You might not find out if COVID lockdowns were effective at slowing down the speed of the coronavirus until after the dust settles. And even then, you might never know whether or not it was the right solution. And so you don't actually know whether or not what you're doing is working until it's too late. And, finally, wicked problems are characterized in that the people who are making those decisions, they have no right to be wrong. That is, there's no tolerance for failure. Put another way, these are just high stakes decisions. So why do we care about wicked problems, right? Well, it's because applying data science to wicked problems is very different from applying data science to what I might call a kind learning environment. You see, in wicked problem spaces, it's the oft overlooked science aspect of data science, which is the key to victory. It's that process-oriented approach of experimenting and testing hypotheses to further your understanding. If you enter into an unkind learning environment with the idea that data science is about finding the baddest model out there and torturing the data until it yields its secrets, you're not going to be practicing data science for long. Let's think about that concretely, and think about how the attributes of wicked problems, for instance, how they challenge machine learning models, right? So let's go back through this list, right? One-shot operations on unique problems. That means that you're working with small data sets, potentially with no historical precedent. You might not have any training data to work with, right? There's no single right or wrong answer. It means that it's hard to classify the problem into a classification or a regression problem. And yes, for all of you out there, even reward functions and reinforcement learning are tricky because of point 4, that there's no immediate test of a solution, right? You don't even know if you're on the right track until it's too late, which makes it hard to design reward functions. No stopping point, well, you don't know when your model's finished training. And with no right to be wrong, that means that you've got to stand by your predictions and that you might only get one shot at it. You've got to be able to defend your logic. The question that I'd give to you on that is, like, how comfortable are you betting the future of your career on the predictions that your model is making? Like, if you can't stay there and say, I'm fine with that, then you don't have a good enough process to apply data science into a wicked problem space, and your solution won't make it into production. So with a little bit of understanding of what wicked problems are and why data science is especially difficult in these areas, I'm going to hand it over to Amin to talk a little bit about where finance comes in and why finance is a problem space characterized by wicked problems.
Thanks, Ben. So yeah, as Ben just described to us, dealing with these ambiguous problem spaces requires a bit of creativity and a high level of attention to detail, especially to how robust the solutions to your problems are. We can tell you from experience that operating in financial markets is very humbling. And there are many examples of people much smarter than ourselves that have fallen victim to the traps inherent with these unkind learning environments, as Ben likes to call them. Finance presents an almost textbook example of what Ben just described. We only get one try, as history takes a single path. We unfortunately don't live in a Monte Carlo simulation, and therefore optimization on the highest expected value doesn't really guarantee the best results. In sample, the optimal solution could have looked extremely profitable, and that can cause someone to risk a lot of capital, only to result in a state of ruin, essentially, when markets behave in a way that hasn't been seen in our test set, or just there's been some sort of regime shift. And in financial markets, that permanent loss of capital means that we can't really just dust ourselves off and try again. We've, hit a state of ruin. This is especially important as a concept for us as investment managers, and more accurately as risk managers to internalize. People are trusting us with their savings, and we have a fiduciary duty to manage client money in a responsible way. We can't just tell people that their money has been lost because a model was over-optimized or the market behaved in a way that was unexpected. The solutions we come up with are required to be robust and manage risks that we aren't even aware of. If that isn't a wicked problem, then I don't know what is. And finally, we never know when our solution is final. We have an infinite number of free parameters, and there's always room for improvement in terms of expected return, in terms of downside risk, robustness, etc. That makes it all the more difficult. And the question of when to stop or when a solution is implementable is a difficult one in and of itself. So, what the question here is kind of, why do these wicked problems come about in our specific domain, which is financial markets? One of the first reasons is your interaction with the system itself can cause the system to change. The very discovery of a profitable strategy, especially if it's based on some sort of systematic pricing, can cause yourself as well as others to learn about it and exploit it until it's no longer profitable. This is kind of a feature of financial markets, which increase their efficiency. However, it makes turning a profit all that more difficult, especially in consistent profit. We also come across a lot of non-stationary distributions in financial markets, as they're constantly evolving. Things like changes in the way monetary policy is executed, the different tools that are now available to investors to analyze and even gain access to markets, and just the general impact of the shifts in human behavior and investment philosophies cause changes in market structure. This makes the generalizability of predictive models questionable. And, the human component of markets also creates a lot of noise, which makes signals due to underlying economic and financial fundamentals really difficult to extract. And then finally, when we're dealing with money, our emotional and cognitive biases tend to get the best of us, especially those related to fear and greed, can often work against us in this type of environment, especially as investors tend to panic sell or experience a fear of missing out. However, I would kind of maintain that the most dangerous bias is the overconfidence bias and the belief that your strategy or your understanding is somehow superior. As we'll kind of get into a little bit later in our talk, having a process that addresses all of these issues can give us a bit of an edge when dealing with these uncertain problem spaces. And Ben can kind of speak to a little bit more towards some of the ways that these aspects in financial markets can lead to failure.
In order to combat some of these challenges, it's also important to, we want to spend a little bit of time understanding some of the ways that you can fail, and especially some of the ways that failure might look differently than in some other domains. So I'm going to take you through a few different examples of ways that failure can occur. So we can kind of start by looking at the chart on the top right. Amin mentioned arbitrage forces, right? So that's the ability of the market to self-correct, to understand kind of what it's done and change. The market also represents some long-term mean reversion, right? If an asset's been performing poorly, it's not likely eventually it will revert to the mean. And because it's usually due to a string of bad luck, for instance. And so, the chart on the top right shows the difference between in-sample and out-of-sample performance of the Sharpe ratio, which is a common metric for measuring investment success. And you actually see that the better that you do in sample is actually correlated with worse outcomes out of sample whenever you make some slight adjustments to, or some moderate assumptions about, mean reversion or arbitrage forces. Additionally, the chart on the lower right shows, another example of what happens is p-hacking. Right? Amin said that we don't live in a Monte Carlo simulation, right? History has one path. And so because of the nature of kind of backtesting, or for instance, backtesting on historical data, the more trials that you do, the more parameter configurations that you test, the more ideas that you test on that same data set, the more likely it is that you're actually going to engage in an innocent form of p-hacking. And so this doesn't just happen running, brute force testing a large number of parameter configurations. This also happens, innocently as researchers continue to try ideas. If you've tried 20 or 100 ideas on the US stock market between the years of, 2020 or 2000 and 2020, you're probably going to find 5 of them, right, that outperformed due to chance, even though you took no action to actually overfit your model. I also want to speak a little bit to how the optimization space in finance is littered with black holes and dark corners. And so I need to unpack that statement a little bit. So, I think a lot of people who are familiar with machine learning and deep learning are, familiar stochastic gradient descent. And you've got, non-convex optimization that you kind of have to work your way through that optimization space. The problem with optimization in financial spaces is that the most profitable in sample space, the highest local peak, could be right next to a black hole of financial ruin. Think about, trading option spreads, selling option spreads during a period of market tranquility. You can essentially print infinite money. It looks like the best trade ever until coronavirus hits or something. Markets experience a shock more than you haven't felt before, and you drop down to a portfolio value of zero. And portfolio growth, once you hit zero, that's it. The game's over. You don't get to play anymore. Financial markets are non-ergodic. And so once you're done forever. There's no chance of recovery. And so those black holes are very dangerous, and they're put right next to enticing spots of localized peaks. And finally, the last kind of and potentially most insidious method of failure that happens in financial markets is this human insight data leakage. And again, because history only follows one path, and having lived through it, having been able to read the history books, we know what happened. And let's walk through an example to clarify why that's so dangerous. A common, method in quantitative finance is trend following, where you try and participate when markets are going up and get out when markets are going down. Right? Let's say that you're trying to build a trend following model to protect against drawdowns, to protect your portfolio when markets are crashing. Let's say that you're doing this in 2016, right? You've witnessed the tech bubble, the Great Recession, the Asian currency crisis, the Great Depression, to understand how global stock markets fail. You see that generally cracks develop first, markets, and once it starts to enter into a recession, markets kind of march downwards. They hit the bottom, slowly begin to recover as conditions improve. Now let's imagine building a trend following model in 2022. Not only have you seen the financial crisis, the tech bubble, Asian currency crisis, but now you've also seen the coronavirus. That didn't follow the same patterns and paths. That one was a sharp fall off a cliff, followed by an even more incredible rebound in a V-shaped recovery. And so as a modeler in 2022, you say, yes, I need to adjust my trend following system to have a fast reacting component in order to handle that case. And then you run a back test and you see that you got great results, and you go to everybody and you say, look at how good my model did during COVID. Look at how well it protected you against drawdowns. But the problem is that if you were building that model in 2016, you would have seen that the fast reacting component was too sensitive. It would have detracted value. It would have been a waste of money. And so the person, that same person building the model in 2016 and 2022 would have taken different actions based off of the information that they had available at that time. So we only, we're building models with the benefit of hindsight. And when you're dealing with these non-stationary distributions, this mode of failure is particularly devastating, and why, as we'll get to later on, backtesting for strategy development is an incredibly dangerous tool. Amin?
Yeah. So in response to that overfitting and p-hacking and, just generally the desire to keep strategies robust and to make sure that they can stay resilient when faced with regimes that kind of look different than in the past, we decouple signal generation from strategy development from backtesting. Signal generation helps us find an informational edge by giving us predictive information and telling us about where our models work and where they fit. Strategy development, on the other hand, allows us to take this information and kind of and a level of conviction in it and build a strategy specific to the needs of the portfolio. This, it may seem like I'm splitting hairs here, but this is an important nuance. If we trade just on the signals that we generate or on our backtest, like Ben was talking about, first of all, we have that issue of potential overfitting. But more importantly, there's no consideration given to the risk management portion of the portfolio or just the holistic portfolio's requirements. On the other side of the spectrum from overfitting, we have a large reliance on intuition, which results in a lack of accountability and repeatability. When errors are made based on intuitive decision making, we lose the ability to kind of understand where we went wrong and make adjustments so that we won't make the same errors going forward. This can be mitigated through implementing a data-driven and process-oriented system, which is kind of what we're going to get to here in a little while. And anytime we're, like I've alluded to before, anytime we're dealing with money and markets, emotional influencers can hinder our outcomes. The fear and greed I talked about, become even more exacerbated during times of market stress or euphoria, leading to even the most disciplined among us to make poor decisions. So we advocate for a systematic approach, which allows us to make decisions and create models in cold blood and allow us to employ that data-driven and evidence-based research process to kind of codify the investment decisions before being faced with those emotionally stressful situations. We view many of these problems can be kind of mitigated through utilizing a multidisciplinary approach. Having expertise in domain coupled with technical ability to process and utilize data through more advanced quantitative methods is a highly attractive proposition in financial markets. However, building a cross-disciplinary team can have challenges of its own. So that's kind of what I want to talk about here on this slide. We can see some of the concepts that Ben and I have already mentioned. We want to ensure that our solutions are iterative and robust, since the domain we're operating in is so adaptive and continuously evolving. We also value being data-driven and systematic so that we aren't relying on intuition, and we want to decouple these signals from our strategy development and our backtesting in order to minimize our data peaking and overfitting. And we feel that this is best achieved through a cross-disciplinary approach. And we feel that the best way to implement such an approach is by building a repeatable process that everybody can understand and also buy into. Gaps in technical knowledge between researchers and key decision makers, like portfolio managers, for example, can be mitigated through trust in this repeatable process. Portfolio managers don't really have the expertise in the cutting edge data science techniques that we want to utilize. At the same time, they need to understand the underlying models that are being implemented into their portfolios. So this repeatable research process can sort of become a proxy for the models that are built using it, and can give key decision makers the comfort that the highest level of care is being used when making decisions through the process. And we think that utilizing like an iterative approach that allows for fast feedback and reporting of interim results between cross-disciplinary teams, keeps everyone in the loop, and we can also use this to extract business value efficiently. The process is the main concept we're here to talk about today. So I'll hand it off to Ben here, and he can introduce us to what we call the Viewpoint quantitative strategy delivery lifecycle.
Awesome, thanks. So yeah, it seems like we spend a lot of time defining like why things are hard, for lack of a better term. But it's important to spend time understanding the problem that you're dealing with in order to build a process that's designed to succeed in that problem space. And so, we view processes as that key to victory. And that's where the quantitative strategy delivery lifecycle comes from, belovingly denoted the QDLC in only a slight misnomer. So what is the QDLC? Well, we'll take a look at a diagram, but yeah, so at Viewpoint, we've got a cross-disciplinary team, as Amin said. Our R&D function comprises people with backgrounds from traditional finance, multiple domains of engineering, computer science, physics, and data science. And the process that we've developed reflects the cross-disciplinary nature of our team. We saw the great utility of the scientific method, the utility of agile software processes, of design thinking, of timeless investment philosophies. We took the best parts of each of these and stitched them together to adapt them to our domain of global quantitative investing, and with the end goal of creating a process that would be just as dynamic and adaptive as the domain that we live in. So what does it look like? Well, we've got a slightly simplified version of it here, but the process is, this quantitative strategy delivery lifecycle. So if you have been attending the conference, I'm sure that you've seen that it feels like every presentation talks about how 80 to 90% of data science projects fail and never make it to production. Our processes have a production deployment. I mean, I think it's more than 50. It's more than 50%. But let's call it around 50%, right? And when we do fail, we tend to fail fast after weeks, not months, right? And we fail fast because there are typically two sources of complexity that lead to failure: irreducible complexity and reducible complexity. Irreducible complexity causes projects to fail when the problem is too hard, the data isn't rich enough, or there's some other aspect of wicked problems which kills a project dead in its tracks. Irreducible complexity can't be avoided. When you're faced with it, the best bet is to not even start the project. But if you do start and then you find yourself, when you find yourself on it, then you want to fail fast in the EDA stage. A lot of people have experienced data science projects which fail slow, and those slow failures are due to reducible complexity, human-introduced complexity, poor processes, insufficient controls, insufficient feedback loops, insufficient engineering. The QDLC is our process which helps to control some of that human-induced complexity. So to give a 2-sentence breakdown of each of its components, right? Ideation. Everything starts with ideation. Ideation is about ensuring that everyone on the team proposes ideas from whatever domain they come from: physics, mathematics, engineering, and finance, all of those as potential projects, and that those ideas are respected and considered. But we also need to prioritize the right projects, which are projects defined by real business value. The exploratory data analysis phase and hypothesis testing, that's all about failing fast and creating positive feedback loops of knowledge and understanding that help to build up institutional firm-wide knowledge across our functional and technical units. This is our time to test our assumptions, and if the path forward no longer looks rich, no longer looks profitable, stop there, move on to the next one. Signal generation basically comprises the entire typical data science process, where we basically extract and process the multitudes of data that's available in financial markets, and we distill that down into a single human interpretable informational edge. The signals that we produce need to be measurable, interpretable, and testable. Strategy development is when we translate that informational edge into real actionable portfolio decisions. The domain experts, which are known as portfolio managers, they take that informational edge and encode rules for what action to take, keeping in mind the risk limits that we need for our portfolios and the real world constraints that impose our real world constraints on decision making. Backtesting, we only use backtesting as a final check to set expectations of future performance. It's not a research tool, it's a validation tool. And finally, in order to get models into production, you need to have production-grade engineering frameworks that are ready and in place to ensure that the models can run in a live and transparent way. All in all, this system is a positive feedback loop where the data scientific research processes that we have build institutional knowledge, which lets us ask deeper and more precise questions. It's a cycle, itself is a cycle to constantly build, iterate, and improve. So we'll work through an example for each of these steps, But, in that spirit of continuous improvement, I also wanted to spend a quick moment talking about, how that iteration applies to the modeling side as well. Anybody who has a business problem and their first thought is deep reinforcement learning is the solution, they better be damn sure that they've exhausted all other options and that they know very well what they're getting themselves into. This slide is really a praise of simplicity, right? Whenever we've got this iteration loop to quickly, test and build things, and we always start simple with understandable, trusted models. The number of, smoothing and filtering implementations is, much larger than the number of machine learning or deep learning models that you should have. Linear regression is your friend. Expert models, interviewing domain experts to build rules-based models. These are all decisions that you can stand behind, that you can understand, and that you can control for. There's fewer modes of failure in simpler models. And whenever you're in a wicked problem, your desire is to stay alive for as long as possible, to keep playing the game. Simple is safer. Simple is often better. But we move up as we gain more comfort, as we gain more trust in our systems and our processes, we are able to move up in complexity, right? We can then start to bring in, statistical modeling techniques. We start to play with linear programming, start to introduce some convex optimization. And only as we start to gain comfortable and prove that, these techniques work, then we can start to move into that machine learning, deep learning problem spaces. But that happens after we've established success using simpler tools and methodologies, not beforehand. So Amin, maybe you want to take over and talk about problem definition and exploration and how we go about ideation.
Absolutely, yeah. So, we start our process by defining and exploring the problem, basically chart the path of our research project. It all starts with idea generation, right? And as Ben said, ideas can come from any source. And, I generally characterize them as either top down or bottom up. Top down ideas come from, identification of gaps in our models or through some need for a strategy that addresses a specific issue. Whereas bottom-up ideas are those that come from things like an interesting new concept in the domain of finance or a new statistical signal processing technique that might enhance our current signals. It's a bit of a mix. So, and throughout our walkthrough of the QDLC process, I want to use an example. We want to use the example of volatility forecasting model that we built at Viewpoint and have implemented as a dynamic leverage strategy in some of our portfolios, kind of make things a little bit more concrete for you. So the idea that sparked this was essentially us asking, how could we use volatility forecasting to adjust our leverage as a risk management tool? Just a really simple idea. And we'll see kind of some of the complexity that we get into as a result. So once an idea has been prioritized, we start by completing a feasibility analysis on it. Here we think about things like how valuable a project may be and start to define the scope of it. We also complete a literature review. And start gathering data sources just to determine if the data is actually viable. We utilize both domain expertise and data professionals to come up with questions that we need to answer through our exploratory data analysis. What do we need to know to start making informed decisions about signal generation and strategy development and so on and so forth? For example, related to our volatility forecasting project, we ask ourselves questions such as whether daily returns exhibit autocorrelation and if volatility clusters, and whether we can replicate common volatility forecasting models such as GARCH in different asset classes. These are all questions that we aim to answer through data, which kind of brings me to my next point here in the next slide. Which is, sometimes one of the most time-consuming and valuable steps in our process, which is data curation. We've all heard the common adage that garbage in You put garbage into a model, you get garbage out, right? So finding the correct data, cleaning, reviewing, and adjusting that data are all extremely important parts of the overall process. And this is another place where we need that high trust across our cross-disciplinary team, as there is a lot of potential pitfalls in financial data that someone that doesn't understand it or is kind of new to it might fall into, right? So some of the common issues that we see include revised data in which data is back adjusted and wouldn't have been readily available in its state historically, which kind of has some interesting implications about what we can do from there. Or pre-adjusted or pre-calculated data from providers that have some sort of forward-looking bias or data peaking in them. So data curation should never rest solely on data professionals, but rather it should be sort of a team effort between domain experts and technical researchers. So I'll go through a bit of an example here on this slide, which is super interesting because we had to adjust our futures contracts for financing costs. So futures contracts implicitly include the cost of financing. So what you're seeing on the futures curve is the actual value of the asset. So in this case, we're looking at a corn futures curve, so that the commodity corn, and the price of it adjusted by financing. So now, without knowing that that there are financing costs built into the futures curve, a data professional might not know exactly what to adjust for. As domain professionals, we can kind of say, well, this is what we need as far as the interest rate to adjust by. This is, it's LIBOR plus 50 basis points or something like that, and give that proper interpretation so that things get adjusted correctly. And because incorrectly adjusting these things can essentially invalidate everything that you're going to do next. So it's really important to have this this cross-disciplinary approach, especially at this step. I'll pass it off to Ben here to talk about exploratory analysis.
Awesome. Thanks, Ben. And yeah, once we've performed the data curation, we've got everything ready. Now we start to move into exploratory data analysis. This is where we demystify the problem space and we start to answer the questions that we had. We're looking to see that we want to have quick, fast feedback loops that, domain experts have questions, data scientists have questions, we answer them, discuss them, and really narrow down and hone in our focus on where we want to go next. We share learnings fast to increase the clarity, and we want to fail fast. We want to quickly know, does it make sense to continue on this project? EDA, often we find that we have to time box it because, with wicked problems, there's no stopping condition. You can just keep going and going and going and researching forever. So we typically have a set of questions that we want to answer and a set time window within which to work. And if we can't answer those questions sufficiently within the time window, then that's a sign that we might be on a wrong path. But what does it look like, right? So kind of going forward with like the volatility forecasting model, we quickly want to understand whether or not volatility is persistent in financial markets. So, whether or not that exhibits, conditional heteroscedasticity, hardest word to say. We put together a few quick charts for this presentation exhibiting that, yes, in fact, these charts should be screaming the answer is yes at you. The having an autocorrelation of monthly volatility of about 0.6 is incredibly strong in financial markets as far as correlation coefficients are concerned. And so these types of quick EDA, and there's more in-depth EDA that goes along with this, but some quick examples. These are early fast indications that this is a fruitful path that we might want to move along. So then we move into, once we've identified that, yes, this is a direction we want to go, we then move into signal generation, where we find our informational edge, right? EDA is going to chart the path, tell us no go, reduce the paths and avenues that we want to experiment with. Signal generation, time to implement, time to build your models. And I want to be clear that signals in this aren't trade signals. They're not buy sells, but the signals are condensed sets of predictive information that can be measured and evaluated. In the context of this volatility forecasting, the signal is the volatility forecast. I think that the next, the 5-day volatility in the portfolio is going to be 12% annualized next week, right? That's your signal, right? They need to be measurable, explainable, and testable, independent of a back test, right? We're looking to see of like, does this provide useful and valuable information that is greater than noise? And when performing, doing any modeling, model diagnostics and residual analysis needs to be included. You need to communicate to domain professionals later on where the model works and where the model doesn't work, so that in the next steps during strategy development, they can actually fine tune and adjust when to use one model and when to use another, taking into account that information about like, where does it work, where does it fail? These charts that we have, these are, a subsample. The left-hand chart is the subsample of a few different volatility forecasting models, right? We have a simple moving, we've got the actual weekly volatility in blue. We have a simple moving average of, 10-day in sample volatility, assuming zero average daily return. We have, a traditional financial model called risk metrics, and, a generalized autoregressive conditional heteroscedastic, blah, 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 GARCH for short. And, one of the interesting things is that we actually then took a look, when you're talking about, where does the model work? Where does it fail? On the right-hand side, we actually see, we tested about a dozen or 15 models. And what we found to be absolutely fascinating was that some of the models that worked the best during periods of shocks often worked the worst during periods of stability, right? The best performing model during periods of shocks was the, a exponential moving average with a loading of an alpha parameter of 0.15, lambda of 0.85. But unfortunately, during shock or stable periods, it was very noisy, right? It was a poor performer. GARCH, on the other hand, was the exact opposite, performing well during stable periods, unstable or poorly during conditions of shocks. And so this information is important to communicate to domain professionals whenever they go to work with some of this information. And, of course, as I'm sure most of the people here are familiar with, is, just as ensembling can help boost performance at the model level in the cases of, random forests and, gradient boosting machines and all these things, it can also be applied intermodel to reduce some of the errors that we see with model bias. Because ultimately, all models are approximations of reality, and they're all wrong to varying degrees in different ways. And in this case, once we performed just a simple ensembling of all of the models forecast at once, it, outperformed the simple ensemble, wound up outperforming any individual model. And that includes the deep learning models that actually had access to the other models' forecasts as features. So just a simple moving average, outperformed the deep learning models, which, I find to be quite fascinating. But, once you've done that and you've packaged up all of this information, we talk about a signal. We want it to be interpretable, measurable, testable, right? That's what we've produced here. We've produced a volatility forecast that our domain expert can understand, work with, and use going forward in strategy development.
Yeah, so each idea that's kind of made it this far takes information from the last step and is built into a building block that becomes part of a larger portfolio. So when thinking about strategy design, it's important to think holistically about how it will fit into the overall portfolio. And this is separated from that last step, signal generation, in which we gained an informational edge related to our problem, because information gained doesn't always directly translate to portfolio utility. So portfolio utility are things like how does this solve the particular portfolio solution that, or portfolio problem that we have, and how does it help with risk management? In the case of our leverage strategy, we consider turnover costs and performance of each model during different regimes, like Ben showed on one of his previous slides there, to build our ensemble weighting in a particular way that really helps us get where we want from a portfolio perspective. And that's how we build our overall our leverage model. So our volatility forecast is essentially informing what the underlying volatility is of our portfolio, and allows us to apply leverage in order to target a specific volatility. We do this by basically creating quantized thresholds and say, okay, well, if our volatility target on our overall portfolio is 15% and our underlying portfolio leverage is 5%, let's lever that up by 3 times and get the volatility that we care about. Now, that's all dependent on the conviction that we have in our signal generation and everything that we've learned up to this point, how much we're willing to essentially trust and build a strategy around it. So that bottom chart there, on the top, the bottom right, is basically showing our leverage model over time. That's a result of the volatility forecasts that Ben just walked us through. So
Finish up.
Now on the topic of backtesting, as we've said, validation, not research, right? Backtesting we use as a purely as a validation tool. If you're using backtesting as a research tool, you tend to fall into that overfitting kind of pitfall. Because history takes one path, one backtest is always going to look better than another, and if we continue to change the parameters on the backtest and on the strategy, our backtest will eventually look optimal. So we use it for validation only, and we scrutinize any sort of unexpected performance and can go back through that iteration loop that starts with exploratory analysis again if we get something that we weren't expecting, or if for whatever reason our strategy doesn't perform as expected. However, it's important to note that reversion back to the beginning of that iteration loop, we've essentially burned our what we call our embargo set, or our final test set, and we've done some data peeking, and reversion back to that the start of that iteration loop should really reduce our conviction in the strategy and in the signal that we've generated up to this point. And just as an example from our volatility forecasting and dynamic leverage model that we've been talking about up till now, this bottom right chart kind of shows what it looks like. The dynamic leverage shifts the distribution of outcomes to the right, which is basically what we'd expect, as being able to forecast volatility versus something that's just statically levered. We should be able to manage risk a little bit more efficiently. And therefore, we could say that the strategy was validated through the backtest.
Awesome. I think we're gonna end it here a little bit early, just to make sure that we've got time to address some questions. But for those of you who want to know what you missed, we're going to talk about the engineering deployment processes, how to put it into production. We had a demo, all that good stuff, but we just went on a little bit too long. So maybe we can take a few questions now here.
Yeah, for sure. No, thanks for that presentation. Certainly lots of interest here. So if the markets are pure, information is accessible, then why do we still see some traders or firms constantly outperforming the index or average?
Yeah, I mean, that's a great question. My answer to that would be that most don't consistently outperform, and the ones that do, maybe they have a better process. that would kind of like be my answer. But generally, financial markets are very hard, and it's very difficult to find people outperforming, especially on the security selection level. Things get pretty efficient on that level. We've done a lot of research into this, and on the macro asset allocation level, there's a lot of like structural things going on and some behavioral things going on that make it a lot more difficult for inefficiencies to kind of go away right away. So things are a little bit more exploitable on that level.
Yeah. And to add on, I mean, I want to be clear. We didn't say the market's not predictable. We said it's very hard to do. Those are two different things. We outperform, right? And we believe that we do have informational edges. So the SPIVA, there is some data that I think over the past 10 years, not a single Canadian manager has outperformed the index, their benchmark, over the past 10 years. In the US, that number is more like 95% don't outperform. I mean, you might be able to correct me on that. So it's not that it doesn't happen, but it's just difficult, right?
Yeah, the numbers are a little better than that. I mean, in the 80 to 90% range, fail to underperform their index, but still. And then you have to think about, okay, well, I need to go and find that manager who's going to consistently outperform. So it's another layer of decision making that kind of makes it all that more difficult.
So it sounds like in the ideation process, you welcome lots of ideas. I'm certain that maybe the idea of cryptocurrency has come up before too. So how have you approached the cryptocurrency question?
Yeah, it's good. It's a great question. And cryptocurrency, we do have a small allocation to cryptocurrency. Now, the reason behind it is that it's become an asset class in and of itself, and we treat it more as a value store. So we look at it as gold. We'd look at gold. We'd look at silver to an extent. We kind of put it in the same category. So it's kind of an asset class that's highly volatile, so that limits the amount of allocation that we'd probably want to it. But at the same time, it's not something that we'd ignore. Everything's kind of fair game.
And then how about atypical behaviors? Because that could also add some noise into the modeling as well too. So just thinking of like activist trading. So earlier with GameStop or AMC, or should we be shorting Russia?
Yeah, I mean, a lot of this comes back to this concept of non-stationary distributions, right? And there's a question of like, are these events that are modelable or aren't they? And then do you, as a if you're going to take a quantitative process, what types of games do you want to get into, right? If you're going to take a quantitative algorithmic track, you want to involve yourself into markets that are amenable to that algorithmic track. If you're talking, GameStop, right? If you've got a view that you can express that as a pattern that's repeatable over time, and that you've got a first principles based understanding of like why GameStop went to the moon, by all means implement an algorithmic strategy in order to trade that, right? If you think that it's a one-off thing driven by current conditions which haven't existed before, maybe that's an area to stay back and go find a different game to play that's more amenable to your playing style.
Yeah, it's really good. And everything that happens gives us a little bit more information. And we take a Bayesian approach. We have our priors, and we update our priors based on new information that comes up and how much conviction we put on that new information.
a subsample. The left-hand chart is the subsample of a few different volatility forecasting models, right? We have a simple
moves that kind of look different than in the past. We decouple signal generation from strategy development, from backtesting.
And talk about problem definition and exploration and how we go about ideation.
Absolutely, yeah. So we start our process by